What's going on? Today, we're going to continue our raising capital series and go into the role of raising capital as we look at scaling and the impact of having additional capital coming into your real estate investing business, whether you're looking to scale your own personal portfolio, looking to grow your fix and flip business, maybe your wholesale business. At some point, you're going to need additional capital. And we're going to talk into a little bit more about those different opportunities to support the growth of your business. So why is capital so vital to success? Because it's simple. Because without sufficient funds, it's going to be challenging to acquire new properties to or increase your investment holdings. That we all get there. We are going to run out of our own capital buying investment properties, or for a lot of times, people are starting with no capital, but they have the vision, they have the mission, and now it's about going out and rallying people around your vision for the company and what you're looking to do in the future. And it's no different than those new starters businesses when you start looking at entrepreneurs who get other people to do provide seed funding, angel investors that get behind the idea that they can invest their money and get further or get more profit in the future. But one of the things that I soon found out, like for me, I had to use my VA loan to get into properties. And after the first one, was like, okay, I can go buy foreclosures and live in them and force appreciation, have equity from day one, just because of the dynamic of the market. There was a lot of different properties to choose from. And so you could focus on a foreclosure, buying something a little bit lesser than what the current value was in order to force that equity and to build wealth that way. But soon after that, I realized, okay, I only move every 3, 4 years. You're capped off back then on how much entitlement you could have from a veteran perspective. And the way that we looked at how to generate more capital, especially since my wife decided to stop working. We made that decision after we had our first child. It didn't make sense for her to go back into the workforce. And so with that, we decided to start flipping houses in order to produce additional capital that we can leverage into building up our portfolio. And that's what we did. So we started just one house at a time, use leveraging hard money. Eventually, we started bringing in money from relatives. My parents invested, and just going through that process, and then partnering with private equity funds, different hard money lenders, and just continue to grow and having different funding sources has been an instrumental part because we had our credit card, we had a lot of credit, going into that first flip that we leveraged for to make the renovation cost and to pay the contractors. And so you got to have that access to additional capital in order to grow. And that's the big thing, that this capital injection that it comes into your business that allows and facilitates that growth opportunity, where with adequate funding you can pursue strategic acquisitions, development projects, diversification initiatives to enhance your portfolio size and value. As an investor, you're looking to manage your risk and grow your portfolio at the same time. And that's one of the things that, having access to capital, it allows you to grow. It allows you to not miss out on deals. It allows you to get into those opportunities. And the better that you become at being able to, one, recognize those opportunities, but two, creating win-win situations where others can partner with you, become investor partners in the deals that you're doing. It allows them to grow their money, but then at the same time, it allows you to grow your portfolio and grow your passive income at the same time. And that's the thing that we look at when we're looking at raising capital. And it's really an art form because there's different ways to do it, and you're going to have your own particular spin on it that's going to work for you, which is fine. But the thing is just understanding that this is how you enable growth. When you look at companies that operate on the stock market right now, when you're buying stock, you're essentially you're putting money into a business that you think has good leadership and the ability to make higher returns in the future. And that's all it is. It's like you're raising money, just like companies raise money on the stock market that's public. You're raising money privately for your deals in order to fund them. And we'll go into more details on just what that looks like for like the syndications with the different exemptions that you have out there with the Reg D funds, with where you can raise money from accredited investors, which allows you to advertise your offerings, but then also where you have both accredited and non-accredited investors with the 506B exemptions, where you can raise money from both, but you are unable to advertise in that case when you have unaccredited investors involved in the offering. And you can have up to 35 members participate that are unaccredited and unlimited accredited investors. So there's just different opportunities there, just depending on your network and the people that you want to target on how you go about raising capital. It allows you to mitigate risk. I talked about it. Us as investors, our number one job is to mitigate risk, because the risk profile risk for a 25-year-old is going to look completely different from somebody that's 65 years old. And so just because they're in different places of their financial journey, and their exposure to risk is supposed to be different, that you shouldn't be taking high risk when you're that late in the game in your investing career. And so that's one of the things, it just understanding that how you look at capital, it just allows you to weather storms. When we look at situations where you have insurance premium doubles in Florida, for instance, or you have opportunities where your property taxes go up, being able to have access to that additional capital, it allows you to weather those storms with the market, cover those additional expenses, but then also it allows you to tap into opportunities when they present themselves, and just it overall, it reduces that risk on your profile for you just having that access to capital. And then various funding options out there. You have a host of different options, from traditional financing, which, when you think about mortgages and traditional bank loans, private individuals that are investors. You have partnerships out there. You have crowdfunding platforms. You got different creative financing solutions where we can bring on seller financing from an owner of a property, but then we can also, provide, different opportunities for them where they can hold back, not take a payment. We've done 100% owner financing. They can take a portion of take a portion of their money as a down payment, then in terms to pay back the rest. There's opportunities where you can take over their existing mortgage as well too. So there's a lot of different funding options when you look at making up that capital stack. That it doesn't have to be traditional when you go to a bank and you get 80% and then you put the 20% down. There's a lot of different ways to where you can blend those different capital sources together to accomplish the deal.